as we have understood from the perspective of call option, let us also understand the same situation from the perspective of the put option. That means when will a put option buyer break even? When will a put option buyer make profit? When will a put option buyer suffer loss, if any? And then when will a put option writer break even? When will a put option writer make profit, if any? When will a put option writer start incurring losses? And remember, as I said earlier, that these are the kind of questions that you are likely to have in your exam. And if you understand them conceptually, then it will be very easy for you to find out the right answer from the four options that would be given there. And you will be able to click the right answer very easily. So let us understand this also again with the help of an example as we did in our previous discussion. So now we are looking at from the perspective of put option buyer, यानी कि जो put option buyer है वो कब ब्रेक इवन करेगा, कब उसको प्रॉफिट होना शुरू होगा और कब वो लॉस करेगा अगर वो वाकई में कुछ लॉस करता है तो. So let us continue with the same example. The exercise price again is 100 rupees and the amount of premium that he is paying is again rupees 10. The only difference is in earlier example we talked about the call option and in this example we are talking about the put option. So let us understand number one. When will the put option buyer break even? So the put option buyer will break even when the spot price is equal to exercise price minus the amount of premium. So when that happens, the buyer of the put option is going to break even. And let us understand it with the help of an example. तो हम क्या बात कर रहे हैं? हम बात कर रहे हैं put option की. Put option का मतलब क्या है? Put option का मतलब ये है that the holder of the option has a right to sell an underlying at a strike price before the prefixed date of expiry. So that is what we are discussing. And we also understand very clearly कि in case of put option, contrary to the call option, where when the spot price is greater than the strike price, the option is in the money. In case of put option, it is the other way around. Meaning what? Meaning when the exercise price is greater than the spot price, then the option is in the money. If the spot price is greater than the exercise price, then the option is not in the money, it is out of the money. And since it is out of the money, the holder of the put option will not exercise it. Let us understand again with the help of an example. So we have 5 situations, and in case of all five situations, obviously as we understand, the strike price is going to remain the same, and because it does not change irrespective of what happens to the spot price. The amount of premium also is fixed in all the situation, and that is rupees 10 for every situation. What is changing is the spot price. So first it is 70, next time it is 80, third scenario 90, 100 and 110. Let us see what happens to the mathematics in this case. So the exercise price is 100 rupees. Spot price is 70 rupees. So exercise price is more than the spot price, and that means this option is in the money. This option is in the money. And since this option is in the money, the holder of this put option will exercise. So if he exercises this option, his payoff is going to be 100 minus 70, and that is 30. So 30 is going to be his payoff, and I'm sure you will remember it would also mean that this option is worth 30 rupees. It will also mean intrinsic value of this option is 30 rupees, and that is how we will understand it. Now, so from the payoff, we minus the amount of premium that he has paid, we get to know that he is going to earn a profit of rupees 20. And I'm sure it is clear to every one of you. So, what happens if the price, the spot price goes up? And this is interesting, and this is where people tend to get confused, and they tend to get confused because if the price is going up, how can the amount of profit that the holder of the put option the amount of profit will go down? But that is the structure of options. So let's look at this way. So exercise price is 100. The spot price has increased to 80. Now remember, exercise price minus the spot price, what is his payoff? His payoff is 20. And that is 100 minus 80, his payoff is 20. 20 minus 10, that is the amount of premium that he has paid, because that is the cost that he has incurred. So 20 is his payoff, 10 is the cost that he has incurred on account of premium, and therefore the difference is going to be rupees 10, and that is going to be his profit. So you can see it very clearly. Then in both these situations, when the spot price is lower than the strike price, he is making profit. Let's take the third situation. Now what is happening? The spot price is increasing to 90. The spot price is increasing to 90. So meaning what? Meaning strike price of 100 minus the spot price of 90. His payoff is 10, and his payoff is 10, and his premium is 10. His premium is also 10. That means what? His payoff of 10 minus his premium of 10 is 0. That means he is neither making profit here nor he is making a loss, and that means his break-even point is what? His break-even point is spot price minus the exercise price minus the premium, and that is his break-even point, and that is his break-even point as far as the buyer of the put option is concerned. So we are very clear. Number one, when is the break-even point? Break-even point for the buyer of the option is the spot price minus the exercise price minus the amount of minus the amount of option premium, and that is the break-even point. Let us understand when his point of profit. So remember his point of profit. Remember, this is a put option. This is not a call option. This is a put option. So his point of profit is when the spot price is lower than the exercise price minus the premium. It is at that point in time, it is a point of profit. So that means जब जो break even point है उसके ऊपर जब price नीचे जाना शुरू करती है, that is the time when he starts making profit. What about his point of loss? The point of loss, of course, is exactly reverse of the point of profit. So the point of profit is when the spot price is lower than exercise price minus the premium. His point of loss, that means the point at which he will suffer the loss of the premium, and that is when the spot price is greater than the exercise price minus premium, and that is where he will incur a loss, or that is where the put option is going to be out of the money, and when it is out of the money, he is not going to exercise, and since he is not going to exercise, the only thing that he is going to suffer is the amount of premium that he has paid. So this is how it would be applicable in case of put option buyer. कि put option buyer का कब ब्रेक इवन होगा, किस पॉइंट पर ब्रेक इवन होगा, उसका क्या फॉर्मूला है. पुट ऑप्शन बायर किस पॉइंट पर प्रॉफिट बनाना शुरू करेगा, उसका क्या फॉर्मूला है, और पुट ऑप्शन बायर किस पॉइंट पर लॉस सफ़र करेगा एंड उसका फॉर्मूला क्या है. आई होप दिस अगेन मेक सेंस टू एवरी वन ऑफ यू.
Yes, sir.
ओके, वेरी गुड दिनेश. पूजा.
Yes, sir.
ओके, वेरी गुड. बमन सर.
Sure, very good.
Okay, good. Very good. Very good.